When I got this invitation from Modion, and I saw the list that is sent to me, I said, oh, I'm going to have a very great time this afternoon discussing with this, very well-experienced executives. All of them I know. So we're meant to talk about innovating for disruption. And from this morning to this afternoon, a lot of the conversations have been around process improvement, have been around product definition, have been around some of the things that basically just makes the revenue side of insurance, the supply side of insurance easier. But to disrupt, there are certain things that need to happen. And one of the things that needs to happen is, first of all, what really do we mean by innovation? Which aspect of it do we really consider disruptive? Even in terms of improvement, what are those things that we believe would really shake the foundation of the industry in terms of its production? What will shake the foundation of the industry in terms of its distribution? And what will shake the foundation of the industry in terms of consumption? Production and distribution seems to be getting the attention, but consumption is not getting the attention. We often talk about consumption as if consumption is going to come by us improving products and improving distribution. But consumption is really what is going to change. And consumption is you and I in this room and the businesses we run. So we're going to be talking a little bit, not about what insurance companies do or what they offer, but about the economics of our business. And how, in talking about the economics of our business, we see the changes that need to come to disrupt. So I have the honor of having Mr. Ekerete Gam-Ikon. So I'm going to ask him first, what really is the DNA? What do you consider to be the DNA of innovation? And how is it that that DNA, how does it bring about disruption?
I like to keep this very simple. I'm not a scientist, so leave me out of science. I'm not your regular artist, so don't expect anything dramatic from me. But I'll tell you, based on insurance, based on my knowledge of insurance and all of that, I'll just say, whether you want to call it DNA or you want to say what is innovation in terms of insurance, I'll give you another word that will help us have this conversation well, and that's experience. So you're asking, what is going to shake the foundation of the insurance industry, insurance structure, insurance behavior, and what have you? I think the experience of the customers is going to change a lot of things. What are they experiencing currently? Nothing. We live in a world of our own. We sit down in our respective offices, develop things that we believe the customers will want, and the customers keep asking that they want awareness. By the grace of God, I've been in this industry since 1990. And I've had low awareness since I joined the industry. And awareness is still low. But guess what? It's not so much that awareness is low. It's also that the people who took the bold decision to buy insurance had terrible experiences. And so we come back to that issue of trying to define and understand innovation, in my own view, to be in the context of the experience people are going to have. So, innovation is what it is. Are you doing anything new? Or are you improving on what is existing in a new way? And so we begin to look at the issues around the experience of people that have engaged insurance. You want to buy an insurance after you have heard all the wonderful stories. Where do you go to? Yes, a company says to us, dial star, hash, and then you go there. Now, as soon as you have announced that, and I say this with all due respect, there's an experience that the person who has dialed that number is going to have. So is it going to change and make the person say to the other person, I've dialed it, dial your own, dial your own, dial your own. And that's the way we are talking about fire catching on. So for me, Tola, that's how I will define it. I don't know whether that helps, but we can come back to that conversation. Thank you very much.
Thank you very much. As my regulator, I don't know how to answer that question or whether it helps or not. So I'm just going to take your response that essentially what you're talking about is from your point of view, we need to innovate, for a more enhanced customer experience. Now, I'm going to take it to the next, so I'm going to be going progressively. Mr. Mimiko. From an insurance perspective, there's been a lot of insurance companies trying to do different things around innovating. Now, one of the conversations this afternoon, which I'm going to pick on, is on pricing. Is a structured paternal approach going to allow innovation, or do you think deregulated approach to pricing would allow for innovation? If you think the structured tariffed approach would help innovation, can you please tell us why? And if you think that it would not, can you also tell us why? And if you think it's a deregulated approach, can you please let us know how, as an insurer and an experienced underwriting person, how you think that would happen?
Thank you very much, Mr. Adegbayi. To start with, I don't agree that a tariff approach engenders innovation. In this highly mobile, forward-looking environment now, we're talking about a new tribe. The currency for insurance today is trust, simplicity, and transparency. Somebody asked the question earlier on. I keep paying higher and higher every day. It doesn't take cognizance of my own risk profile. So innovation really will come from us being more analytic, using big data, analyzing those data to inform, instead of it being product-driven, it has to be customer-driven initiative. So when we have customer-driven initiative, we'll be talking about products that, solutions, I won't call it products, solutions that are tailor-made to meet that customer's risk profile. And then you can do proper pricing in that regard. And how can this proper pricing be done? It has to be data-driven. It has to be what we call usage-based insurance. You're paying as you go. You're paying based on your habits, based on your behavior, based on your own risk profile, rather than it being flat and everybody's being charged a tariffed premium. I think that's, in a matured market, you won't see that happening. But because of where we are in Nigeria, I think that is why we're still having a tariffed regime. I think the NIA chairman spoke to it earlier on. But in terms of consumer protection, it is important that we use data analytics to drive pricing. And that's what I think is more innovative rather than having a tariffed premium regime. Thank you.
So I'm going to try and say it more directly. So essentially, you're more for a deregulated pricing market, because that deregulated pricing market would help to improve on innovation, and hopefully that innovation will be disruptive.
Absolutely. A deregulated pricing market will be what is best for innovation. It helps you, as I said earlier on, profile the customer appropriately and price them accordingly. So that is ultimately where we should be heading towards if we're talking about innovation.
Okay. that moves me to Mr. Lango. I'm aware in the past, that your company has also been at the forefront of bringing new products, trying to do mobile-based insurances. So I'm going to flip that question a little bit back to you as well. Is that the industry has been so much focused on product. But I want to bring an aspect in, and nowadays it's called solution. Where is the place of underwriting as against just having predefined products that we push on the market? How do we bring back the underwriting discipline, and what are the required elements of data, statistics, actuarial science that will be brought in to ensure that underwriting helps to aid an innovation that is disruptive? Do you think the underwriting would help? And with everything that is happening now with Gen AI, basically a general knowledge, type of artificial intelligence system coming in to democratize knowledge, how much of underwriting do you think that this democratized general AI would help? And when you take the underwriting, how much of that underwriting will also help to improve on innovation and also disrupt, the process of insurance and ensure that enhanced customer experience that the regulator spoke to?
Thank you very much, Tola. Let me stand on the existing protocol. You have asked many questions. Let me see how far I'll be able to answer. It's important to note that in the design of product, if we do the same thing the same way, you'll likely get the same result. So by implication, if we do the product just thinking of what people need and design the product to meet their need, the penetration that we desire, we may not get there. Number two, competition led us to a cash flow underwriting, where you just collect premium and you don't put data into consideration in determining what the premium will be. Lifestyle or attitude are not put into consideration in determining what the pricing will be. Then claim experience is not put into consideration in determining what the price will be. I think that era is maybe is gone with NIRA, basically because a lot of money will need to flow into insurance, and the investor will demand return, and the business will need to grow. So the implication is that for disruption to take place, there will be the need to know the need of the Gen Zs, the larger population who will need insurance. And when you know their need, you will now create products to meet that need. In creating products to meet that need, data comes into play, where you will need to determine the pricing of the product. So that's the place of underwriting, coming from claim experience to available data to behaviors before you be able to get into the pricing. That also will reflect in the profitability of the product, because that will be taken into consideration. Then the experience also will be built over time. So, but in summary, disruption is necessary to achieve insurance penetration. Innovation is required to make the product acceptable. It's not what we think we want to give to them. It's what they need. Then talking about underwriting, underwriting is the process of assessing the risk, considering experience, and determining the appropriate price for the product. It will now be the client will need to know that the price is commensurate with the risk. Some have high exposure to risk, while others will have low exposure. In underwriting, this is put in consideration in pricing. And when the consumer sees fairness in pricing, and that takes me to the issue of tariff. If there's fairness in pricing, and I'll give a very good example. If someone have a car, and you use that car from mainland or Abuleba to Victoria land, and drive that car every day. There's another one that is having like 3 cars and works in Ikeja from Abuleba. It's ordinarily reasonable that the man that has 3 cars and lives not far from where he works should pay less premium compared to the man that has 3 cars, 1 car, and is driving lots of kilometers to Victoria Island. So that's where the place of underwriting comes in. And the fairness and transparency on the consumer of insurance make them to accept insurance, that there will be fairness in the pricing, and it will be easy for them to pay. It also will assist them to manage their risk, because they will know that they will pay less. The underwriter will charge them less premium if they are able to manage their risk appropriately. I don't know if I've been able to answer your question.
Well, thank you very much, to a certain extent. There's something that you said that is going to bring me to basically then ask Mr. Oyinlade the next question. And what you said is something about it is the market that influenced the creation of a minimum rate, so to speak, because we were doing cash flow underwriting. And so therefore it was necessary. But now, an aspect of creation is chaos. And chaos itself is part of what is required to disrupt and to develop. So my question to Mr. Oyinlade is that, have we been very careful and have we tried to go back against something that would have enabled us to go forward, i.e. as in cash flow underwriting, over competition between insurers? What is the place of chaos, and how can we bring chaos back into the industry to enable us disrupt and then innovate for what is going to be beneficial to the customer? Are we being very careful about chaos and not allowing disruption and innovation to happen in our industry?
Hello. All right, thank you. Unfortunately, the simple answer I will give is no. And I guess this is coming from our background as risk manager. Because we are supposed to manage the risk, unfortunately, we bottle ourselves up in not being able to open our mind to see what we can do out of risk, out of chaos. A typical example, when we had the bomb blast in Nigeria, nobody thought of what kind of insurance can we put in place. We had the bomb blast at about early 2000, if I'm not mistaken. Nobody thought of anything. When I say nobody, I mean the industry. Not until we have the Boko Haram bombing of the late 90s or late 2009, 2010. That is when we begin to open our mind to say, come, there's something called terrorism insurance. But why do we have to wait for a decade later? Before we can disrupt, before we can innovate, we have to take a look at every chaos as an opportunity. 2 days ago, it rained in Lagos, maybe for about 24 hours, but we can see the level of destruction in terms of flooding. But we see this coming every year, year in, year out. Now, as insurer, what do? We don't want to underwrite that risk. We shy away from it. Rather than us investing, partner with climate institution, partner with institute, and see what we can do. Can we avert this risk? No. Would there be flood next year? Yes. But what are we doing? What we are doing as insurers is that we will not write that risk. We count it as bad risk. But if you are not writing it, it means that we are closing our mind to innovation. We should sit down and ask ourselves, this is a risk. What is the solution? And I think that is where we are missing it. So if you ask me, we don't go back. And there's no way we can move forward without looking back at where we're coming from. When we talk about big data, people think big data is something of the future. But the reality is that if you look at insurance in Nigeria today, we're sitting on a whole lot of data that we don't need to look for data somewhere else. All we just need to do is to couple those data together in a way that we can make sense out of it. Can we do this? Yes, we can. Why are we not doing it? We are not giving ourselves a deep thinking. Between NIA, NICOM, and the rest, there is a whole lot of data. But I think we are moving in the right direction. I'm happy to hear that for the first time, we are building our own mortality table in Nigeria. We have been using mortality table of England done in 1940s, which is not in any way in sync with our system. But can we build our own? Yes. What will that do to us? It will enable us to price well, to understand our risk, and to ensure that we are actually selling to people what they want. Because the data we are using is out of our own people, not the data of 1940s, not the data of other continents. So the summary is that for us to innovate, for us to disrupt, one, we have to take advantage of chaos that has happened, that will continue to happen, to innovate.
Thank you very much. And again, your comment is what I'm now going to also move forward to Mr. Akerele. Now, there's a physical chaos that happens around us, but within our industry itself, there's a pricing chaos that we shied away from. Now, if we're going to take advantage of the pricing chaos within our industry, what do we need to do? Do we stop having a cartel system? Do we request the regulator to only concentrate on the third-party liability aspect and leave the discretionary products to be properly underwritten based on behavior, location, age, all the different underwriting or risk considerations that needs to go in? Then also, even in terms of the liability as well, do we challenge the regulator in a regulatory disruptive way? Okay, Mr. Ikon looked at me sideways. He was not paying, it was whatever. In a regulatory disruptive way, also say to the regulator, can we stop tariff on third-party liability policies? Can we allow liability policies to also be, price deregulated so that I don't have to charge 10,000 liability For somebody whose liability exposure should actually be worth 100,000, and somebody whose liability could be at 10,000 or 7,005, can we then begin to look at that as well? So what do you say to that? And please, I would like for you to be as, not diplomatic. I would like for you to be as direct as possible, but in a nice way, if you can. Thank you.
That was a direct comment. So a nice question. And I want to appreciate our regulator for being consistent to start with and staying through the entire, presentations. And that shows the direction. And it shows once you believe something is real, you put your entire energy in it. They are leading from the front, and you can see the whole lot of collaboration that has already started. The bit the regulator will do, and this is quite frankly from me, is to give the enabling environment. They are not the players. We are the players, okay? We have the data. And then what do we do with those data? The data are supposed to be used to direct our course of action, right? Now, if we're able to use those data very well, we can determine what kind of price would sit with us easily. But if we don't use those data, then we don't have a basis to actually agree on what price will work. So, and that is why technology is really key. Technology will enable us to harness those data. Of course, big data means analytics will set in. But it's not just about the data. It's the quality of the data. It's what you do with the data. There could be data and all that, and it's directing you somewhere else. But if you refine the data and be able to present the data in such a way that it gives you something as close as real, then when you pitch your tent about the pricing, you know the reason why the pricings are going that way. Nothing just happened for nothing. The technology we're talking about started from a point of need. So we need to go back to those basics. Now, underwriting is critical. It's what we do in Nigeria, really. We don't practice underwriting to the fullest. If you look at the basic motor insurance, what happened is that the underwriter will look at where that car is parked, the location in which that car is, driven on a daily basis. Now, what is the experience of the driver? What's the quality of the road? That comes in together to do a pricing. And they get all this information together, and they fill it into a data, and it gives an idea of what kind of pricing we run. Now, no business run as NGO. It's not possible. You run the business to make a profit in the long run. So you have your data, you clean up your data, and you're able to agree that there's a pricing. Of course, it could fluctuate because depending on the experience over time. And then you come in, you pitch it in. But of course, it can't be permanent because you keep on challenging the status quo. For practitioners, we need to do a whole lot of deep thinking, right? Where are we going in this whole thing? When you talk about disruption, we are going to do business not like normal. Something completely different. It's a change of behavior. It's a change of the mindset. A shift completely. A change on the market value. What can we start doing that the industry, the insuring public knows we are already adding value to it? It's not pushing products. You don't push product. We pull it in so that the customer starts seeing value connected in it. And is ready to pay a premium for it. And what next? There are the other elements that flow with technology. Then you're talking about how you are able to deliver the service very well. What kind of customer experience is the customer having with you? Will you want to come back to experience same? Or finally we settle the claim? But it took a whole long time and the stress that goes with it. How are we able to simplify our wordings in terms of policy wordings and all that? How are we able to deliver those policies in such a way that the customer is seeing some tangibility with an intangible product? That is the work. That is when it starts. And that's why I'm extremely excited about this, because it makes every practitioner go back to the drawing board, do deep critical thinking. And it's not your product you are pushing. You are trying to deliver service. You are trying to disrupt in such a way that the customer see it as a lifestyle. It's then we'll start doing business.
Thank you for your last word, which would then help us to go to the second leg of the discussion. The customer will see it as a lifestyle. I like that. Now, there's a tendency for us in insurance to talk more from the supply side and to talk more from the revenue side, and how government has also helped us to maybe enforce the purchase of insurance. But one of the ways by which we have to think of insurance is actually that we as insurance, we are buying risk. When we flip the narrative to the point that we're buying risk and not that we're supplying products, some things need to change. As a risk purchaser, we need to build systems. And as a risk purchaser also, we need to know what are the ethics of the development. It drives us to begin to look at each individual as a risk and the commonality of risk between each individual. Now, part of what we need to discuss when we're talking about, innovating for disruption is when we begin to look at risk as we buying risk, not that we supplying products to the market, we then must talk about building systems and ethos that would enable that marketplace of risks that we're purchasing, to be appropriately priced, bought, and then we exchange the risk we have bought from the customer with a financial document. We call it policy, but it is a financial document. We exchange with a document that has a value on it, and each person is then buying the value that is on that document. So when we're buying the risk, we're basically exchanging for money. So we exchange money with the customer, and the money we're exchanging with the customer, if you buy a risk from a customer, you've given the customer 2 million naira, just for the sake of example, worth of cover. So you sold money. I'm not going to go to the regulator. When we begin to flip the script, and I know in some of your social media comments, because you've been an insurance advocate before you also went to the regulatory side, yes, is that you have the concept of the insurance wallet. And I know I've had conversations around insurance being money. Yes. Now, I need to ask you, from a regulatory standpoint, what are those things that we need to create the right architecture? And I'm using all these words that, you say you're not a scientist, but we need to bring it, because as insurers, we're general knowledge people. We also have to know a little bit of the different industries that we cover. So permit me when I'm using DNA and architecture. So that's the context. So where's the, what kind of architecture do we need to have to build the right system that will change the scripts in terms of insurance marketplace from selling products to buying risks? What are the archetypes that we need to have defined in terms of those risks? How do we engineer them? How do we embed them? How do we tell customers that, by the way, I'm not selling you products, I'm just buying your risk? What are the risks you have for sale? You're selling it to me, I'm buying it for you for 2 million naira, of which in selling it to me, you've given me, 10,000 naira for the risks that are bought. Now, in terms of that's on the building system. The second part of it, because of time, is I'm going to also bring in the ethos as well. So ethos itself is about the characteristic spirit, of a thing. It's essentially about culture and aspiration. So what should come from the regulator in terms of building systems and in terms of setting the base for culture and aspiration that the industry participants, whether they are the buyers of the risk, whether they are the intermediaries for the risk that is being sold in the marketplace, what are those things that we then need to have in place so that when you are then looking back at the marketplace, you'll be proud of, as the regulator, for creating these systems and enabling this ethos to operate within the marketplace?
Okay, thank you very much, Tola, and I completely accept the fact that as insurance practitioners, regulators, and what have you, we certainly must have general knowledge of everything. And the truth of the matter is that on the insurance side, we struggle to keep ourselves complex, technical. And people say insurance is not easily understood. And we sometimes are happy to make it difficult for people to understand it. And that way we think we are earning their respect. But the truth of the matter is that, you know, cultures, like you said, have made it possible that what seemed to have been barriers before have now been broken. And I like what the headline speaker for this event said at some point. Whether it's insurance, whether it's banking, whether it's telecoms or retail, the customer doesn't care. He just comes and he connects and he wants to have an experience. Once that experience is bad, it's bad. He doesn't know whether it's coming from insurance or it's coming from banking and what have you. Now, we are at the point where we have a new law. Now, this law, I must remind us, is innovative friendly. This law is also customer focused. This law is also pushing operators to become, you know, to have the growth mindset. How do we grow this business? And so, I like the perspective. We are not selling products, we are buying risk. Which is why I made that reference in the last session that it is the liabilities that we are carrying that should be of more importance to us. It's not that you have collected premium of 5 million for a car that is valued at 100 million and you are excited. The liability that you are carrying is what you should be bothered about. How do I ensure that this 100 million, doesn't happen? But here is where we are. Today we are talking cyber insurance. And some of us know that from an insurance knowledge, you would say maximum probable loss. It can't happen. It can't happen that all the houses on the street will be on fire. It can't happen. But with cyber risk, everything can be swept off. And that's why it's difficult today to find a reinsurance company that will say it's giving you reinsurance cover for cyber insurance. But work is progressing on that. So the dimension you've brought is that when you look at the risk that you're bearing, your perspective to the business changes. And you are now forced to look for solutions as different from just saying, we are offering a product, this is how much the product is, if a claim happens, we will pay you. No. So how do we, from a regulatory point, deal with this? Some of the things that we are thinking about based on NERA, of course, like you know, we are saying it's not enough to say, I have the minimum capital requirement, you know, that is required by the law. We are now looking at the risk that you are bearing and saying, does your capital, does your capital sufficiently support the kind of risk that you are carrying? And so the discussion is not just something that we are thinking of, it's something that we should consider now. Because as you sit down now, there are companies that are sitting down here, maybe the requirement for them is 15 billion, maybe they are composite, the requirement for them is 25 billion. But the risk they are carrying in terms of the liability that we have described is massive. So they need to begin to then look at it to say, does this capital support it? And for aviation risk, for example, we have said companies that are doing aviation should not expose more than 5% of their balance sheet to that line of risk. So it's, for us, something that we have put in place in terms of some of these specifications. And don't forget, we have moved from just having a rule-based law to having a principle-based law, which is coming to the real issues of insurance. And that's what operators need to be mindful of. Because in doing the risk-based capital calculations and all of that, we're going to look for things that you are already aware of, but which you don't pay attention to, because you are looking at how to grow your premium while we are mindful of what risk are you carrying. So risk-based capital is one of those things that have been put in place, And clearly, we are also spending time to educate people on how this will work. So it doesn't come to you as a surprise. And which is why we had the solvency control, and intervention framework before now to prepare the market for it. Having said that, in terms of capital, we are also mindful of what capital you are bringing in.
Mr. Ikon, I'm going to cut in, if you don't mind, because
great.
I was just told.
But I hope I have been able to, address that.
Yes,
Thanks.
to a certain extent. So quickly, because apparently we have, that's the disadvantage of when you start late. So the later, people tend to be cut short. So unfortunately, we need to hurry it up now. So I'm going to ask in a flow. We're talking about risk-based capital. We also have the IFRS. All of this have, in a way, encouraged the insurance industry to innovate for disruption. So internally, we have, and within the new NERA as well, we have two newly recognized in addition to the Chartered Insurance Institute. We have the role of the statutory actuary, and then we have the role of the reporting actuary. But what you often find in an organization sometimes is that you still have the underwriters. How do we blend the role of the actuary with the role of the underwriters so that underwriters who, again, as we've said, have not been underwriting for a very long time, begin to value the statistical nature of their work, that they can then seamlessly collaborate with the reporting actuary to ensure that the company does what it's supposed to do in terms of risk purchase and is also profitable enough for sustainability, whilst also having impact and value on the community. So I'm going to take profitable, Mr. Mimiko, sustainability, Mr. Alagbo, and I'm going to say community impact as well to Mr. Oyinlade. Then Mr. Akerele, in terms of community, I will then finally ask you to cap it quickly off, because there's something you said, and that's why this is coming to you. That sometimes when we're on the right, it's almost as if there's no point, it's almost robotics. What is the role of robotics in insurance? Do we then, for those simple products that does not require an underwriter or an actuary, do we robotize everything so that we can pay the underwriters that are left, who are really the wisdom holders, more, so that they can be as valued as the reporting actuaries of companies? So, start with you, Mr. Mimiko. And I guess you all have a question, so I don't have to repeat it. Thank you.
Again, thank you very much, Mr. Adegbayi. Just to lay the foundation, when it comes to doing insurance right, that data analytics must be gotten very, very right. And that speaks to the work of the actuaries versus that of the underwriter for underwriting, for profitability. As it is today, we all have different data scattered everywhere. One of the solutions we must be talking about in terms of building that ethos and system is having that culture of dropping our legacy practices and thinking and rethinking how we do things going forward. Because the revolution is here. That disruption is now. That said, I will say that as an industry, we should be collaborating, all right? It's going to be an operator-led reform, not necessarily a regulator-led reform, to start having insurance data bureau, where we have a repository of data that helps the analytics I'm talking about. And when we do these analytics very well, we're able to price rightly so that we are underwriting in a disciplined manner, and as a result, you're underwriting profitably. It's a win-win thing. You can't continue to price with a rule of thumb or just have a tariff-based pricing like we mentioned earlier. So in terms of underwriting for profits, underwriting profitably, there's that need for advanced data analytics And it all starts from how we gather data, how we gather information that is not only internal to us, but even external. And my encouragement here will be collaboration among insurance practitioners for us to be very, very intentional in building systems, building platforms that can make us have that data repository, just like they do have a credit bureau in the financial service sector where they do proper profiling of people that want loans and all that. So we can also do same, and it will help us price appropriately. Appropriate pricing, discipline underwriting engenders profitability, and it adds value to the insuring populace. Insurance must move away.
I'm going to have to also, because of time, flow the repository, the data repository, into the question of sustainability. Mr. Alagbo.
Okay, thank you very much. So you have said that you have analyzed the recent happening and requirement, both locally and globally. So IFRS 17, for the purpose of uniformity in reporting and also ability to interpret data in the same manner. So the actuaries, the work of actuaries, you will see that actuaries are now becoming very relevant under IFRS 17. You have the auditor, you have the actuary, very relevant. When you talk about risk-based capital, you see the importance of actuary again, both statutory actuary and reporting actuary. They become very relevant. You now see the underwriter also. You see all of them have different training, and it's the goal is to ensure that there is clarity, there is transparency, and the business is sustained. So the training of actuary relates to seeing numbers, having defined assumptions, and creating maybe rate or position of the organization. The underwriter is looking at the training, the experience in assessment. The actuary will not assess a risk. They will only what's been assessed, what's been the experience is what they will rely on in informing or reporting. But in all, it is for the purpose of transparency, for the purpose of confidence, so that you will see less of company getting into liquidation without caution, some stopgap, some pointer to possible collapse or danger if the organization is not properly run. So, in summary, the work of an actuary is becoming very important now because of their training. Underwriter is also going to be well properly managed, assisted in underwriting because of the reporting of the actuary. And the auditor also now, there is a lot of control through the report of the actuary when they are putting their report together. Thank you.
Thank you. Community impact.
Okay. The insurance itself, the whole concept of insurance is about making impact and making impact wherever we find ourselves. But what we need to do more in terms of community impact, even in terms of our underwriting, in terms of running our business to make profit, is that there are certain information that are available to us as practitioners, be it in short term or long term. So, for example, if you look at the data of life insurance company today, from the profiling of all the death cases, you can infer some things. Because when you have a scheme and you have deaths reported, you are meant to collect those data and make inference from it, get back to the society and say, this is what the data is showing. This is what we are seeing from the market. And from this way, you can help. We hear a lot of fire here and there and the rest. The question is, do we go extra mile to find out what are the causes of those fires? Are we collaborating with Federal Fire Service, for example, to give them an insight into what we are seeing? We settle motor claims every day. How well are we giving back to the society by, working with Federal Road Safety, for example, and say, this is the pattern of what we are seeing, either in terms of location, either in terms of age, either in terms of particular types of vehicle. So beyond what we are doing to the society, and the Honorable Commissioner mentioned it, if we like, we can pay hundreds of billions. If we don't sit back and ask ourselves, how are we contributing? Then the people we are trying to serve will not see value in what we are doing. So as insurer, it is not enough for us to see this data. Let's analyze this data, take back and see how we can improve the society, which ultimately will improve our risk profile.
Thank you very much. Now, substitution, robotics, and
Yeah,
Gen AI.
yeah, it's a thing that has come to stay. Reality is that you can't go so far as an industry player without embedding those tools. All the industry, go check it out. They've gone through various stages, right? If you look at the manufacturing, what happened? AI came in. You have robotics running stuff for them. They are turning out things faster. They are more efficient in those basic, normal day-to-day things. They build it up. But what happens, right? There's a whole lot of capacity building there. New knowledge comes in. New understanding of how to do things better. That's on the medical side. That's on the manufacturing side. On the medical side, what has happened? Now, the doctor, yes, you're a doctor, you're trained, but you need to use the AI tools, getting to diagnose, ailments a whole lot faster, and almost precision in terms of solving those problems. There are quite a lot of development that come in because of those tools. For insurance, we can never be an exception, right? It's a change for the future. It has come to stay. It's disruption. But you know what that gives us? More opportunities. And what is the opportunity? To learn new skills, to learn AI-based skills, so that we can improve in terms of delivery, in terms of efficiency, in terms of how customers are delighted when they get to feel our service. And that's the direction. And I guess what? The regulator has thrown the right signal at the right direction by embedding that in the current NERA. And what did they say? Digitalize. It's not an option. It's mandatory for your business to scale, for your business to build traction. And insurance really is law of large numbers. We need the large numbers. And for you to do large numbers, you need to have those analytics. The AI tools must be in place for you to try. And the flip side is this. The regulators just told us, of course we know via NERA, your capitalization base has moved from 2 to 10 for life, 3 to 15 for general, and of course 35 for reinsurance and all that. But watch out. How will you make return on investment if you don't invest in the critical tools that will make you move and go places? The differentiating factor is this, right? Technology has come to stay with insurance, and we are going to all evolve. And if you don't evolve along those lines, you're going to face extinction very soon. For me as a person and for my company, we have done that. Our process has been digitalized from the beginning. Yeah, we are very advantageous because we started small. We started from the scratch. We didn't buy any license from anybody. So we're able to build up our process. You come into my office, you practically not see any paper around because we have our data, we are building up and all that. That technology is disruptive, is going to continue. Guess what? The Uber experience and all the other businesses, where did they come from? Those guys don't have vehicles on ground. They are using platforms to run it. So we as a company, what we have done is also to leverage it. You don't reinvent the wheel. You will never do that. It's there. So you adapt it to your situation. Adaptation is the name of the game. We have a tool, we have an app running, Advantage Connect app, go Google it, and you see what it does. It helps the customer to monitor his transaction within us, keeps the track. It also helps us to build up our base. That's enough, I guess.
I don't know whether the organizers would allow Enterprise Live to take the stage as marketing. Oh, okay. So that is allowed because I was going into the marketing side already. One of the things I want to cap, and I don't know whether we have time for audience questions, is also that we're seeing substitution internationally in terms of, insurance operations. And what do I mean by substitution? First of all, in terms of risk survey, and we don't seem to have any risk surveyor within this event. So maybe that would be to IMT 5.0 to try and include insurance risk surveyors and loss adjusters in the event. And why? Because that is an area where we're seeing a lot of robotic substitution. Within the insurance industry also, we're seeing claims analysts, being substituted. Because with Gen AI, you can basically program your policy into the system, and if a customer has a claim, the system is faster summarizing whether the claims is covered or not. And then you really need to then find other uses for claims analysts within insurance companies. In terms of the direct survey that insurance companies also do, we're seeing a number of robotic substitution in survey, particularly in agri insurance. There's a lot of tech involvement in some of the risk areas, that we're seeing. And I think maybe we need to be more collaborative in terms of when we talk about disruption and innovation, because a lot of it is happening elsewhere. Now, we're also seeing that from an underwriting perspective within our industry, we have, I don't know how many of us, maybe one, is there anybody in the room that owns a BYD? Is there anyone in the room that owns a Chagan? So we have BYD, electric vehicle, in country now, build your dream. And we have Chagan, they're Chinese manufacturers. How easily are we positioned in the insurance industry to begin to underwrite for the electric vehicles that are coming in, because they're going to become more and more common? How do we integrate with our, software as a service company? How do we build systems that takes the electronic information from these vehicles into our underwriting? So these are the things that is going to change the Nigerian insurance industry in a very significant way. And a lot of these are already happening elsewhere. So now I'm going to open, with that summary, I'm going to open the floor. If there's any, if I'm allowed, I think we have just about 5 minutes. 1 or 2 questions from the audience, please. Audience question? Oh, at the back. Okay, sorry, I don't know if you have a microphone for the lady at the back, please. I don't know if you would...
Yes, we have a microphone. We'll
okay,
get
thank
to
you.
Right now. All right, please introduce yourself and your organization. Thank you.
Hello, good afternoon. My name is Polami Hafso, and I'm from Isaac in Lagos. And my question is quite conservative, seeing as I'm not really in the insurance field, but I feel like risk is something that applies to everybody. And this panel has been quite exposing, seeing everybody throw around the word innovation, disruption, even chaos. But I want to ask, does innovation have to be disruptive to be valid? As experts in insurance, you might have analyzed a lot of businesses and ideas where the core of the idea or the solution is to currently scatter what we have now to build up something new. But is that something that should always be done when innovation comes up? What are times that, maybe examples you've seen or current things that you feel what we need to have solutions is just simple organization or simple regulation as opposed to scattering what we have now? So that's my question.
Do you have a particular person you want to answer that question? Mr. Nelson, okay.
Yeah, thanks for that question. Yeah, there are two layers to it. One is the incremental improvement. The other one is the issue of disruption. When you talk about incremental improvement, we are talking about doing what you're currently doing more efficiently, right? For instance, instead of the issue of the manual forms you having an online form that you can easily fill and that can easily get information and elicit all this information you want to elicit from the customer so easily. We are talking about getting a process where your claim processing that takes a shorter time than a longer time. You are talking about giving something unique in terms of the customer experience in such a way that the customer wants to come back, do a repeat sale, and then can expand your brand along those lines. Those are incremental improvement because you're already doing the business. But when you're talking about disruption, you are talking about a complete mind shift, something innovative that has not happened before. Just like you compared when Netflix came in compared to the blockbusters. What happened? Netflix transition. At first it started slow, but right now I rather prefer to just sit down in my house, do my subscription, and watch virtually any movie, on Netflix, right? What happened to the hospitality business? Same thing too. The Airbnb. They are then challenging the conventional hospitality business. I want to go to somewhere where I can feel like home away from home. And they walk a platform around that. The same thing with the Uber. They never own any vehicle, but they run on the platform. And it's going from innovation saying, what does the customer really need? What does he want, right? He wants to be able to book up a car hailing service with ease without going through the hustle of staying with the sun and all that and looking for a taxi pass. You're not connecting the provider of the service with who needs the service. That is the disruption we are talking about. Now, if you look at, sorry, okay, round up. So that will continue. In insurance, that's exactly what we're saying. We're saying a complete mind shift. Why is that mind shift expected? Because the opportunities are enormous. Yeah, law of large numbers says our population is a plus for us, but we have not done enough. We are less than 1% GDP. What does happen? Opportunity. For the fintech guys, this is the best time because the underwriters very soon will have enough money on their hands, right? NI has done something. The innovation lab, go showcase your craft. Tell them you can solve a problem within the industry. And then look at that. Get an accelerator. And of course, the capital will flow. That is what we are talking. Identifying that mind shift that will make something radical, transforming the penetration level of insurance to something higher, just like we have in South African market and some other East African market. Thank you.
Any other question from the room? Okay. Well, it's been a very engaging session so that I can hand over and I don't take too long on the time to the audience. Thank you very much also to the audience for your participation. Thank you.
Fantastic.